For you to have a successful retirement, you need someone who can not only financially plan for you, not only wealth management, but also knows their taxes as well. This gentleman knows it all. He is Marcus Warren, and he is a great resource on this show. It is Warren Wealth Management. Welcome back, Marcus.
Thank you.
You were telling me you cleaned up at the track, right?
Oh, no, not at all. Got a lot of tax tickets, though, right? You can write that stuff off against, the wins.
That's what's great about a guy like yourself, man. So you don't need to win at the track because you've got everything in order. There's easier ways to make money, and you know how to do that.
Yeah, write off all of those losses at the track with really very little winning. So, it's all a wash, right?
There we go. There we go. We highly recommend that you attend their workshops, and we'll talk about that, Marcus's workshop. But before we do, today the topic is mistakes that will ruin your retirement. You've got your top 6, right?
Yes. So, in retirement, people really don't think about taxes a lot. And what they have to understand is that, assuming you're going to have some sort of income in retirement, which most people want an income in retirement, Uncle Sam and the government is going to be, they're going to have their hand out, and they're going to want a piece of that. And so what you have to do is you have to make sure that you have some sort of strategy, some sort of plan to minimize taxes down the line. And there's a lot of mistakes that people make in retirement.
So what you're saying is pay close attention to taxes.
Yes.
That's a big one here. Also, you've got coming in at number 5, not contributing to a Roth IRA or 401k. So what you're saying is take advantage of those. If you haven't, is it too late to get in? Is there a threshold where you go, okay, now it's too late to get in?
It's like this. The Roth IRA is one of my favorite types of investment vehicles, and the Roth 401k, simply because you put money in. It's after-tax money. You put money in, it grows tax-deferred, and when you pull it out, it's tax-free. And so when the government passed this, of course, they thought, hey, this is too good. And so what do when they think something's too good? They put limits on it. And so for a Roth IRA, you only can contribute $6,000 every year if you're under 50, and $7,000 if you're over 50. And so they have the Roth 401k. And with that Roth 401k, I like it even better because you can put even more money in it. But a lot of companies don't offer them. If you're wondering if your company offers it, then you probably should check with your resource manager, human resources benefits person. But you can contribute up to $19,500 if you're under 50, and up to $26,000 if you're over 50 in that Roth 401k. And just like I said, when you pull that money out, it is income tax free. And the problem is this, with most people, they really just don't think about taxes. And I think people equate working with paying taxes. And once they stop working, they tend to think that, okay, maybe this tax thing is over. Said, Uncle Sam is going to want his piece as long as you're getting some sort of income, really pretty much until you're dead, John, until you're dead.
Yeah, Uncle Sam is always going to have his hand out. Okay.
Right.
So if you just joined us, we're talking about 6 mistakes that can ruin your retirement. Okay, coming in at number 4. You say taking withdrawals in the wrong order. Now, this one I am not familiar with. What would be considered a wrong order?
Well, it's like this. There's generally 3 tax buckets. You have your taxable bucket, you have your tax-deferred bucket, and then you have your tax-free bucket. And that tax-free bucket is what we talked about with the Roth IRAs, the Roth 401ks. Your tax-deferred bucket is your company retirement plan, 401k, IRA, 403b, and then that taxable bucket pretty much is everything else. And so once you're retired, how do you go about pulling money out? You can't pull it out in a willy-nilly or haphazard way because there can be tax consequences. And in prior weeks, we've talked about tax diversification. And as long as you have assets in those 3 buckets, you have tax diversification. And so it would behoove everyone who watches the show or who meets with me to sit down with a good fiduciary advisor who can pretty much focus on your individual situation and find out what strategy of withdrawals is the best for you. Because if you pull out of your tax deferred bucket and then decide to go to your tax-free bucket, that might not be the right way to do it. You can save a lot of money in taxes, number one, with tax diversification, and then making sure that you pull money out in the correct order.
It's a good reason to talk to Warren Wealth Management, because if you don't know, you can lose thousands of dollars, literally.
Yes.
Okay, next up, we're going to talk about taxes again. Social Security. Please tell me We're not going to taxing Social Security.
Yeah, so when I have my seminars and workshops, this is one of the bigger ones. We talk about Social Security taxation, and a lot of people look at me and say, I didn't even know my Social Security could be taxed. And I'm like, oh yes, it can be taxed. And they get upset because they're thinking, wait a minute, I had to pay basically a tax while I was working because I had to pay out money to this Social Security Trust Fund. And now you're saying once I work for 30 or 40 years contributing to Social Security, when I pull money out, I'm going to have to pay on the way out too?
Yeah, you're getting taxed twice.
Right, and the answer is probably. And you know, the way that the system's set up, basically the government counts what's called provisional income. And that basically means any income that you have while you're retired, rental income, pensions, IRA distributions, anything like that. Anytime you pull money out, they count that, and it determines how much of your Social Security is going to be taxed. And so if you make over $34,000 in provisional income and you're single, 85% of your Social Security can be taxable. And if you're married and you file together, and you make over $44,000, 85% of your Social Security can become taxable, and people don't think about it. But there are strategies that you can use to, you know, minimize some of those taxes down the line.
Okay, and coming in here at number 2 is something you've already touched upon, but let's get into it a little bit deeper. Everyone assumes taxes will be lower in retirement. You've already said, yeah, maybe not.
Right, and that's simply because people have heard their whole entire working careers, defer, defer, defer. Why do you want to defer taxes? It's because the assumption is you're going to be in a lower tax bracket in retirement. And why would you be in a lower tax bracket? Because you're taking lower income, right? But that's not what people want to do once they retire. I mean, once you retire, do you want to not make as much or not maintain your standard of living?
Nope.
Right, of course not. And so because of that, most people are finding out that they're paying just as much in taxes in retirement as they were while they were working. And the scary thing is we're probably going to have higher taxes in the future. We work under the assumption that taxes are going to be higher in the future. Why? Simply because the national debt. We are spending money like a drunken sailor, John. You know, we're, you know, trillions of dollars and trillions of dollars are just
pandemic didn't help.
Right, it didn't. Right,
No.
and we're throwing money. We're throwing money out there, and then we have all these unfunded liabilities, Social Security and Medicare. And we had a lot of the baby boomers putting money in, but now a lot of the baby boomers are retiring, and they're going to want to take that money out. And where is the government going to go to pay their bills? They're going to come to us in the form of taxes. And so you cannot assume you're going to be in a lower tax bracket, because more than likely you're not.
All right. And in summary, number 1 is you need to call Warren Wealth Management because you need a strategy.
Yes, yes. And so the number one tax mistake is you have no strategy on how to minimize your taxes, and you have to be proactive. You have to make sure that, hey, healthcare is going to be one of the biggest expenses in retirement, and then taxes are one of your biggest expenses in retirement. And so you have to have a plan for both. We at Warren Wealth Management, we do investments, but we also do tax planning. And we always say you don't have a comprehensive retirement plan unless you have a tax plan.
All right. With my final 30 seconds here, if you would, you've got a workshop that is coming up, right?
Yep.
Let's talk about this.
So we have a workshop that's coming up. It's next Tuesday, May 11th at the Shelby campus at U of L. It's at 6 p.m. Seats are filling up fast. I really think we only have 5 or 6 more seats available.
Good free information.
Good free information. We talk about taxes. We talk about retirement. You can go to warrenwealth.net or call the number on your screen and sign up, but sign up quickly.
Always a pleasure, Marcus.
All right, thank you.
All right, Marcus Warren, once again, Warren Wealth Management. All right, coming up here, your most valuable asset is probably your home. Okay, let's talk fire safety. Ron Hickman will do that with the lint eliminators next on Wave 3 Listens. We're live.